mic session. Thank you so much for joining us. Usually Simon runs these. Today I'm running them, so you're stuck with me, unfortunately. But I'll promise I'll do my best. I'm Jeff, and together with Simon and a few other people, I chair the TLA Fintech Group. I'm also a partner at Bain, where I lead our global fintech business. I was just explaining to the guys that if it wasn't for COVID, I'd be somewhere, probably somewhere very, very exotic, as opposed to being stuck in central London. But hey, it is what it is. I'm really excited to have an absolutely stellar lineup today with some amazing speakers, and I really look forward to a great discussion in the next 54 minutes or so. I'm also very pleased that we have Stuart from DIT with us today, who'll tell us a bit more about their leading edge program and how to get involved. Before we start with some introductions and before I hand over to Stuart, just a couple of quick points. I mean, we really wanted to make today's conversation as interactive and engaging as possible. So please do let us know if you have any questions. Don't necessarily wait until the end. Either post them in the chat or just come off mute and raise your questions directly. Imagine we're all in a pub together. I'm sure you all remember those days, and we're having a chat about some of the exciting things happening in the industry. So please do engage in the discussion today. Just as a quick reminder, I will be recording today's session, so those who weren't able to join us today can watch the discussion at some other time. All right, let's get started. Stuart, I'm actually going to come to you first. So please do tell us a bit more about Leading Edge, what it's all about, and how people can get involved.
Great, thanks, Jeff, and thanks to you and Simon and the TLA group for inviting me to this call today and giving me the opportunity to talk about the Leading Edge program. I know we partnered with TLA on this initiative, so it makes sense to raise awareness of the program to your colleagues and to your members. So just to introduce myself, I work in the UK Department of International Trade, and I work in the Fintech Trade and Investment team. And we've recently launched this Leading Edge Global Partnerships program. And our thinking behind it was that as a result of COVID-19, we thought it would be a good opportunity to go and have a deep dive into how the pandemic has impacted the digitization agenda of overseas financial institutions, and really identify which fintech subsectors they were paying more attention to, whether that's RegTech, payments, lending, or in tech that helps them in their digital transformation journey. And as a result, we launched in December at the Singapore Fintech Festival an initiative that we've called the Leading Edge Global Partnerships Program, of which its USP will be to identify specific fintech use cases within financial institutions overseas, as well as understand their particular procurement cycles. Whether it's a proof of concept, a pilot, or a white labeling solution that they would want to onboard, as well as wanting to understand their particular entry criteria they have for UK fintech, with the objective of actually matching them to export-ready UK fintechs. So the initiative will initially focus in having conversations with a select few overseas financial institutions in the US, Singapore, and Australia. And the reason why we chose these markets is that given the evidence there is of significant fintech interest here, and we also have existing bridge agreements with the likes of Singapore and Australia, as well as the existing UK-US financial innovation partnership. However, the aim is to eventually extend this initiative out to other markets around the world and share with our overseas colleagues in DIT key learnings from our initial engagements. Maybe just to provide you an example of how the initiative has worked so far is highlighting a couple of conversations we've had with a couple of US banks, where one of them explained to us that they were looking for alternative credit risk assessment providers that had previous experience in partnering with financial institutions, and ones that specialized in loss mitigation, which enabled them to better understand the credit risk profile of their business customers. And it's something that they felt had become even more challenging given the US payment protection program had distorted the market conditions. And as a result of this, our team was able to look at the UK fintech ecosystem and find ones that really cater to that demand. Through our due diligence and desk-based research, we've been able to provide them with information on which UK fintechs have expertise in this space and which have experience with financial institutions. In Singapore, we've also had initial discussions with the major Singaporean banks there, the likes of OCBC Bank, DBS, and UOB, with whom we've shared a terms of reference to develop an informal partnership. And in the introductory conversations we've had with them, they've been also very specific in the fintechs that they're looking for, and it's been a bit more varied than in the US and very niche. I mean, for example, one of the banks there is looking at, fintech in the trade finance space, wealth management, as well as ones that specialize in, facial expression and measuring customer sentiment, as well as ones that provide banks with insights into customer behavior. So it's a really vast range and very niche and very forward thinking on their part. And examples of entry criteria that the likes of Singapore and US banks have shared with us is, whether the UK fintech has an existing relationship with the bank, whether or not it has a physical presence in that market, and what its headcount is. But these are just some instances. We also had conversations with banks that do not have a strict entry criteria. So I'm trying to paint a picture in terms of what criteria there is around. And I mean, right now we want UK fintechs to engage with us across different verticals, whether whatever size they are, whether they're small, large, and whatever kind of vertical they lie in. And whilst we collate information on fintech demand within overseas financial institutions, we also want to capture really useful information around the UK fintech ecosystem, as well as understanding UK fintech's international expansion plans and letting us know which markets they are prioritizing. So, as well as capturing information on the entry criteria a financial institution has when onboarding UK fintech, we want to understand which markets that fintech is looking to expand into, which is a really crucial part of this initiative, as it enables us to filter the UK fintechs that we will consider introducing to a financial institution, which we hope improves the chances of a UK fintech partnering with an overseas FI, given the due diligence we will have carried out beforehand. And in order to help us with these efforts, we've partnered with the likes of Innovate Finance, City London Corporation, your guys at Tin London Advocates, and London & Partners. And we've also solicited their help in raising awareness of the initiative, which is why it's really important to come on these really productive calls and share comms around this, and helping us select UK fintechs that they feel closely aligned with the fintech demand overseas and their entry criteria. And part of spreading awareness of the initiative will be to direct UK fintechs to a landing page that we've created with a clear call to action for them to provide us at DIT with information that we seek around their turnover, their headcounts, and which part of fintech they really specialize in, as well as their current international footprints, as well as the markets they're prioritizing in the next 12 to 18 months. So what I can do is I can drop in the chat function a link to the landing page, and really encourage UK fintechs that will be listening into this conversation, and also banks to reach out to us and complete the survey there for UK fintechs to fill out. And there's also an email for UK FIs to also, not UK FIs but overseas FIs, to really engage with us and learn more about the initiative. So that's a wrap up in terms of what Leading Edge entails, and happy to take questions down the line, and please feel free to reach out to us. Over to you, Jeff.
Excellent. Thank you so much, Stuart. I think it's a fantastic initiative and hugely valuable for UK fintechs. So again, thank you so much for sharing the overview, and from our perspective, we're very pleased to be partnering with you and to supporting you and the team on this journey. So please do reach out to Stuart afterwards if you have any questions, or if you want to get involved or know someone that would like to get involved. All right, let's get stuck in. We've got quite a bit to cover today, and again, we've got two absolutely phenomenal speakers joining us today. So let's start with some quick introductions, guys. Josh, why don't you kick us off? Tell us a bit more about your journey and your background.
Sure. Thanks, Jeff. And thanks for organizing. So quickly about me, I am a lawyer. I went to law school actually during the original .com era. Started my career at the Federal Reserve, where I was very focused on the plumbing of the financial system, so the payments piece of what the Fed does, as well as working with the monetary policy function of Fed. I spent some time in banking, mostly focused on capital markets, particular regulatory capital, and then I joined fintech. So this end of 2016, started 2017, fintech called Checkout.com. As COO, I helped Checkout go through a very, very rapid period of hypergrowth. When I joined, I think there were less than 100 people. When I left, there were over 800. So over a 3.5-year period, we expanded across the globe. This included everything from licensing to expansion of our financial partnership networks, growing headcount, growing the sort of infrastructure that supported the business, and more recently, I joined Wilson Sonsini. Wilson Sonsini is the leading technology law firm, leading law firm for private companies. And what we're doing here in the UK is really focusing on helping European, UK tech companies access the US. And that could be accessing the US in terms of financing, both private and public financing, access the US for purposes of M&A transactions, and access the US more sort of literally, right? Actually expanding into the US. And that's everything from, well, on the fintech side, that's everything from incorporating in the US, employing people in the US, to navigating the licensing environment, the regulatory environment in the US, navigating partnerships with financial institutions along the lines of what Stuart's talking about. So that's a little bit about me, and I'm sure we'll dig into some of those different experiences over the course of this call.
Excellent, thank you so much, Josh. And Mike, same question for you. I mean, you've got such a fantastic background as well. So please give people a bit of an overview of your background and your experience.
Yeah, hello everybody. Nice to be a part of today. So I've worn a few hats over the years. I've been an advisor in the city for kind of over 20 years. Initially, kind of late 90s as an M&A lawyer, then flipped out of law into investment banking, mainly doing tech stuff in the UK and Europe from sort of 2004 onwards, and then just shy of a decade in investment banking, and then moved into wealth management, focusing on tech entrepreneurs mainly. And frankly, not an entrepreneur, but with my wealth management hat on, working at Credit Suisse, I think we can engage with entrepreneurs at all stages of their life cycle, frankly. And one of the things that I kind of enjoy the most is kind of bringing to bear kind of the variety of experience I've had from a deal perspective to try to ensure that the guys that I work with have got someone in their camp that they can kind of bounce ideas off, almost like a quasi-personal chairman type role in many instances, to help them make good financial decisions. And that can obviously impact their own personal wealth, because that's my job. But it also, when you do the job properly, I think it encroaches into so many different other areas. So as I say, picking up on a legal background and the investment banking background and the networks that gives you means you can be quite a useful gateway for people, frankly. So it's good to be involved in today. And I think one of the objectives, of course, is to kind of facilitate the ecosystem and to kind of be available for people. So yeah, I look forward to catching up if people want to.
Fantastic. Thank you so much, Mike. Guys, I want to start with just sharing your perspectives on the UK investment landscape. Obviously, we've seen lots and lots of exciting activity in recent years, a rapidly growing angel investment scene. We now see some of the US VCs setting up shop in London as well, which I think is a great testament as well to the strength of the UK tech sector. But I'd love to get your perspectives on the UK VC and investment space. So a bit of history there as well, and how do you think that space has evolved in recent years? Josh, I'm going to come to you first.
So I think from our perspective, one of the things we've remarked on in the last few years is the increasing presence of U.S. investors actually in the UK, what we're seeing is, I mean, you're now starting to see some U.S. investors actually set up shop here. But with COVID, there was a sort of leveling of the playing field in terms of access. And as a consequence, for the very best companies in the UK and Europe, there's an increasing level of access to US venture. So I think that that's something that has been a big change in recent years. And has the potential to have a big impact on how the ecosystem evolves.
And Mike, from your perspective, again, you've done a whole bunch of interesting work in this space as well. How have you seen this space evolve in recent years?
Yeah, I look back on when I left investment banking, moving into wealth management, I was doing work in the FIG space, recapitalizing the banks in the crisis, basically as an investment banker. And then with my tech experience moving into wealth management, sort of the fintech space was kind of burgeoning in 2011, 12. But there was a legitimate question back then, which was like, will there ever be a unicorn in Europe? I mean, it sounds silly to kind of even mention that now, but that was a legitimate question. I think one of the biggest changes that I've noticed is that there's been a kind of redefinition of what success actually looks like. I think there's been so many massive success stories, and the pipeline of success looks so ripe that I think that's one of the big takeaways this last decade of opening people's eyes to actually, if you do grow and focus and have the right market opportunity and the right execution capabilities, you can achieve big things, like the sort of things that people would expect to achieve in the US. That's one part of it. Like facilitating that obviously been as access to capital. I mean, Josh mentioned kind of where that's coming from, and that's one of many different sources. I mean, as a private wealth advisor, I think you also look at the power of the retail investor and people's appetite. I think the more headlines you get in the press about unicorns and success stories, and the more people have kind of had children who become entrepreneurs or friends who become entrepreneurs, and it's become a bit more ubiquitous to be in that kind of self-employed type space. There's been a greater sense of awareness of opportunities to invest in early stage ventures and excitement around what you can achieve, not just to kind of financially, but also emotionally by contributing as a mentor, or even kind of just the interest of being involved in something disruptive. So that's the sort of second point, really, access to capital and people's willingness. I think the government's been very helpful with regard to incentives. Like small little things change, like people's pension contributions become lower, but they divert money to SCIS and EAS type ventures, and therefore the capital flowing into early stage has been fantastic. I mean, I mentioned before the financial crisis. I mean, what I noticed then was that the classic big employers from big universities, with the kind of the law firms and the management consultancies and the banks and the accountancy firms, etc. And I think as those firms started to kind of become less attractive to the next generation of talent, I think and the opportunity cost in terms of potential rewards became less. People were no longer intellectually landlocked by these kind of big branded employers. And I think a huge amount of talent then got sucked into the entrepreneurial space that would have otherwise gone elsewhere in previous decades. So I think over the last decade, it's been a confluence of all those factors that's really resulted in the kind of success stories that we're having, and no doubt going to continue having in the decade to come.
Excellent.
I think Jeff, just add one thing on the back of what Mike just mentioned. I mean, I think that there was a view, right, that post financial crisis, a lot of these incentives were put in place to actually create a job market, right? So and that's, you know, and that's also can shape sort of what were the ambitions, right? Were the ambitions of those policymakers just to build alternative sources of jobs, in light of the fact that they thought post financial crisis there might be a decline in the ability of the city as traditionally defined to fully employ all those graduates that Mike mentioned coming out of school, or was the objective to create tech companies that would rival U.S. tech companies? And I think it's more likely the case that the ambition was really more just to create alternative sources of jobs, right? So the objectives were perhaps more modest, but maybe more sensible, right? And now we're seeing this evolution with the arrival of U.S. money, that pressure and that focus on not just creating employment, but actually creating these large tech success stories.
Yeah, I mean, just to build on that a bit more, Josh, I had a fascinating discussion with a good friend of mine the other day, and we were talking about London versus Silicon Valley, and I think London has come. If you compare London, the London tech sector today, versus 10 years ago, I mean, we've come a long way, and I'm very pleased that we have people like Ross and Ben on the call today, who've played such a vital part in that success story. You mentioned the US, Josh. Obviously, it's a very mature market from a VC and from an investment perspective. If you look at markets like that, what is it that we in the UK can learn from those markets?
So, I think just to sort of set the stage, I think there's, and we've already alluded to this a bit so far in the discussion, but there's a really strong stylistic difference between the U.S. investors and the Silicon Valley investors and the European investors, and at the risk of overgeneralizing. And there is this sense with the U.S. investors that it's what they're looking for is these moonshots, these change the world type companies, whereas the sort of the old saw about the European investors is that it's really more private equity masquerading as venture capital, and so it's much more about more modest outcomes, but with nice asymmetric payoffs where you're really protecting downside and you're happy with with a reasonable upside. And I think that's something that may need to change. I think one of the things that we've seen in the Silicon Valley ecosystem that's developed over time is a really strong alignment between investors, founders, and employees, and by that I mean sort of everyone is incentivized by a large increase in equity value of the company. I don't think that's yet ubiquitous in the UK European market. The other thing you see in the US is that everyone involved, not just the three constituencies that I just mentioned, but also all the advisors, are in it for the entire life cycle. So, so for example, the Wilson Sonsini model is a very deliberate model where we work with companies that aren't just ideas, and we actually help the founder incorporate. Then it becomes a baby company, and then it becomes a teen company, and then becomes an adult company. And throughout that whole life cycle, we stick with them. And when you have people, the advisors, employees, founders, investors, all willing to get involved through that life cycle, and then also become repeat players, right? We talk a lot about nowadays we talk a lot about the PayPal mafia, but there's lots of examples of that in Silicon Valley. You create a much more arguably a much more vibrant ecosystem with a lot more opportunity for success to breed success, and I think that's something that hopefully the UK and European sectors will emulate, because it will have this sort of this nurturing effect where the ecosystem starts to sort of become very highly sustainable and perpetuate future success stories.
Yeah, I think you raised some excellent points, Josh and Mike. I mean, you and I were chatting the other day about the importance of having that ecosystem and the different components you need. I mean, what are your thoughts on that? I mean, looking at so many other markets you've operated in as well, and then looking at the UK market.
Yeah, I suppose my experience is a bit more UK based. I think whilst the world's global, I mean, the industry I work in is pretty regulated, so I see a lot of kind of UK entrepreneurs expanding into the States. I think sometimes they see it as a kind of huge opportunity. I mean, when I was working with listed companies, I mean, the US has been the graveyard for many experienced management teams with large capitalizations of their companies in the UK, and they're trying to take their business models to the States, and it's not been successful. I think when you've got an earlier stage business and you're trying to do the same with less resources and perhaps less experience, then the risk gets dialed up. So I think people get enticed by the US. I think US kind of thematics definitely come to the UK and Europe eventually. I mean, one thing we touched on last week was, I mean, I'm not an expert in this by any stretch of the imagination, but the US SPAC market last year, there must have been kind of 200 SPACs going public. In Europe, there's a kind of handful, I think 10 or something, I think 2 of them European listed. But I mean, fintech is going to be one of the areas where that potential play is going to be very, very popular. I mean, what do SPACs want? They want fragmented landscapes. They want ability to kind of spend a lot of money. They want innovation and high growth. I mean, when you get that type of ecosystem like fintech has right now, I think it's going to be in demand, not just kind of in the UK and Europe, but US and globally. So I think it's the ecosystem that everyone coming together and sparring each other to improve and innovate faster and to deliver and execute better is keeping everyone held to account. And that is definitely helping put kind of the UK and Europe on the stage in a very kind of meaningful way. As I say, I mainly work with UK guys, but when they do their cap raises these days, it's no longer just the local VCs that are getting involved. It's a global base, including Asia and China. It's not just about the US anymore. So in some ways, the move to the screens and home working has made the world more global in many ways, because actually access is by everyone's tablets, right? So in some ways, once you've got the connectivity through the advisor network into the pots of capital, I think the opportunity for current entrepreneurs is massive.
Yeah, no, very true indeed. I just wanted to pause to see if there's any questions or any comments from our lovely audiences. I know we've got the likes of Ben and Ross with us today as well, who've got a wealth of experience in that space. So I don't know whether, not to put you on the spot, but whether you wanted to share some of your perspectives around the UK investment landscape.
I'm going to pass to Ben first, and then I'll follow up after Ben. So Ben, do you want to jump on and respond to that?
Thank you. I'm sorry to admit that I'm having massive technology problems. So
all right.
Never mind fintech. I'm struggling to get any kind of tech at the moment. So forgive me. That's why I'm off screen. I'll try and reappear later on. But no, I don't want to interrupt proceedings by fragmenting and fuzzing. So if I may, I'll keep my own counsel for a moment.
Ross, do you want to jump in?
Do you want me to go ahead and just respond to that? Sorry.
Go for it, Ross.
Yeah, I think, I was speaking to a journalist at Wired this morning, and we were talking about what's been going on. And, I said, look, I was so pleasantly surprised with the level of investment into UK tech last year. And obviously the bulk of that, or good percentage of that, is going into fintech, which to me is a real vote of confidence in terms of what's happening in the sector and the growth that we're seeing. I've also been part of something called the Fintech Project Review, which has been kind of coordinated with DIT, Treasury, Innovate Finance, City of London, and EY all playing key roles on it. And there's been a number of work streams. And I think a lot of the recommendations coming out of the report, which we'll hopefully hear more about fairly soon, are going to be very significant and very important, I think, for the UK fintech sector. Especially if we manage to implement many of the recommendations that are going into that report. I think it's going to really help underpin the UK fintech ecosystem. I sat in the international aspect of that piece of work, and coming back to Stuart's point about fintech bridges, there are fintech bridges in place. I think, well, obviously with Singapore, I believe with Korea, with Australia, et cetera. And they've been good, but I think they've been under leveraged. And I think there's going to be a real push to create more fintech bridges around the world. I've certainly said that we need to have one with the US and really deepen that fintech relationship between the US and the UK. So what I'm seeing coming, and obviously I can't share a lot of that just yet, but if we can make that work, this group, many organizations will be asked to step up and be involved with supporting UK fintechs in their international expansion, but also how do we get more fintech businesses to come to the UK and really turn the UK and specifically London into that fintech hub. So that's one thing that I'm really interested and excited by. I think the other thing is that, you know, the UK is very strong in fintech, but we can't be complacent. I mean, I also do say, and Jeff, you've heard me speak about this. We're doing something with the TLA China group, which you co-lead, and the retail group, that, you know, the Chinese are just leading the way on e-commerce, which is becoming S-commerce. And how do we really understand what they're doing? And I think we need to do the same for fintech. Yes, very different ecosystem, different way of working and operating, but we really should learn and understand what they're doing. I think there has been a big wake-up call in terms of how China has stepped in with the whole Ant Financial IPO, in terms of literally stopping it a few days before and saying Ant Financial needs to be much more heavily regulated. And so I think we're going to see a really interesting transition in the fintech space in China going forward. And I think we should be watching that and observing that. So China's doing some interesting things. Obviously, you know, Josh has talked about the US. The US is very interesting, but how do we build our global position more effectively from a UK point of view? I have many memorable experiences in running this community. And one of them was back in October of 2019, when I was invited to the ZGC forum in Beijing. It's a national forum that's held every year. And I was invited to speak about UK fintech and the growth of UK fintech, because I think the Chinese admire how quickly the UK has built a vibrant fintech ecosystem. And part of my remarks were to talk about the Financial Conduct Authority, DIT, you know, how our government has really played a key role here. And I didn't have to do that, because the two speakers in front of me, you know, the whole event was in Mandarin. I think I was the only English speaker there, were waxing lyrical about the FCA, the sandboxes, the innovation, and how the FCA is such a terrific regulator, and that the Chinese should be looking at how regulation gets done in the UK to help them to build their fintech ecosystem. So we've got many good things going for us. To me, it reinforces why we've had such strong investment levels in the UK, particularly in fintech. And I think one last comment I'll make, you know, touches on some of the points made earlier, is that, you know, I know that there's some discussions underway about the London Stock Exchange, making the listings process more attractive, encouraging more fintech businesses to list on the London Stock Exchange. And I think there's a lot of excitement that there's probably at least 20 to 25 UK fintechs that are looking to go public over the next 2 to 3 years. And obviously a concerted push with both the private sector, the London Stock Exchange, the City of London, and Treasury and government to say, let's get the bulk of those to happen here. So hopefully that just paints a picture of what I'm seeing and experiencing on my end. And apologies if you're hearing a little bit of background noise. I have the digital minister, Caroline Denenage, on a call here that I'm also supposed to be on from DCMS. So I wanted to jump in on this, but I'm going to probably jump onto that in just a minute, because I think she's got some important things to share. This just gives you a bit of a glimpse of my world these days. So Jeff, I hope that's okay.
Yeah, thank you so much for sharing your perspectives, Ross. And clearly, you know, lots and lots of exciting things going on, lots and lots of opportunities, but also still a lot of work, you know, for the UK to be done.
Yeah, we got to keep working hard at this. We've got fabulous fintech businesses, great companies, but let's not be complacent, and let's not call ourselves the world leader in fintech. Let's say we're becoming a world leader. We're not there yet, but I think our future is bright if we keep doing what we're doing.
Excellent. Thank you so much, Ross. Josh, Mike, I wanted to shift gears a little bit and focus a bit more on the advisory side of things from a founder perspective. So I'm a UK founder. I want to either raise some equity or raise some debt or whatever it may be, and to really scale my business. What advice would you give to me? Obviously, it sort of depends on the stage of my business, but what advice would you give? And again, I'd love to find out a bit more about your experience dealing with different founders. Mike, I'm going to come to you first on this one.
Yeah, so it's a complicated topic, and I think founders, when I first meet them, they are 100% focused on their business, and in the early days, it all feels like hard work, but kind of everyone's pulling in the same direction. I think as your cap table becomes more complicated, as you have different investors at different levels, at different stages with different requirements and board seats, and then employees with options they want to realize and growth plans and exit plans. And actually the ecosystem gets quite complicated quite quickly. And I think one of the dynamics is how to manage all those conflicts, essentially. And the hat that I try to encourage people to put on is, look, every now and then you got to think about your own situation. So what's in it for you, i.e. as an individual, not as a CEO, as an employer, and as a sort of a manager of all the various stakeholders, to kind of think, what are the objectives for you individually? I think we talked before about how things have changed, and one big sense I've got is people's willingness to let founders take money off the table is complete step change from what it was 10 years ago. I think everyone's grown up a little bit, everyone's matured, and frankly, most investors are more concerned about their CEOs burning out and not having financial security and having anxiety outside of their business life. That means they can't perform at the top level in their businesses. So when you come to kind of advise them on cap raising, I think it's understanding not just this deal, but what your journey is. What options are you going to have? You don't need to pre-decide what those are going to be, but so given my experience having the various advisory hats on for a couple of decades, I do enjoy those conversations because you can kind of give people landmarks and signposts to say, look, this is likely what's going to happen next, and this is what these guys are going to want, and you can anticipate kind of problems. I mean, a classic one I saw in the public markets was a silly thing, really, but a CEO of a listed business very rarely is allowed to sell any stock. I mean, joke aside, but it was generally only if they were buying a house or getting a divorce, with the market would let them sell anything, frankly, without a huge amount of pomp and circumstance from the financial PR people. So I remember as an investment banker doing loads of work, kind of trying to market and protect the rating of a business just because some execs want to sell. And if you translate that into the private world, if a founder's never sold any equity, ever, when it comes down to a big corporate event, corporate action, if it's the first time they're ever going to sell, then if you've got an hour slot with a variety of investors to pitch, you don't want 10, 15 minutes of your pitch dominated by, so why are you selling for the first time? Have you not got any confidence in the growth and all that negativity? So I always encourage people to think about being equipped to answer those questions quite easily. And often that's done by selling a little bit early on and just progressively selling little bits early on. It sounds a bit self-centered from a wealth management perspective to try to encourage people to sell, but that's not really the point. I mean, a decent wealth manager, you're not going to move their kind of business needle by selling a fraction of your equity, frankly. It's about getting yourself well positioned to have a good message and a consistent message to your stakeholders. A bigger evolution too in the sector has been people's sophistication and knowledge of how to use a capital structure effectively. I think people used to talk a lot about share classes and pref rights and what kind of voting controls you can get, a bit like a kind of a legal session 101 at law school. But in the last 5 years, especially, I think the dynamic around when you can use debt in startups to protect equity and to use a capital structure in a much more efficient way that enables people to achieve their goals is a very interesting point. I mean, the last thing I'll mention actually is I get a lot of entrepreneurs coming to me to try to get liquidity on their positions. And it's difficult for entrepreneurs because banks tend not to lend against things they can't diligence very well. founders tend not to want to sell because they want to keep their concentration and their ownership and their equity upside. But there are funds materializing that are allowing people to take cash off the table without diluting their economic interests. So I think everyone's got a bit more sophisticated. And I think the conclusion for all that is that when people are thinking about their options, my advice to them is always to ensure they're surrounded by people that have got experience of lots of different situations, but also experience of lots of different outcomes. Because whilst every entrepreneur I meet is super optimistic on their opportunity, the data set indicates that not everyone is successful. And therefore, as I said in my introduction, one of the things I enjoy about my job is to kind of be in someone's camp and available to them to bounce ideas off so that they can hopefully make the best decisions that maximize their chances of success, really.
I think you're absolutely spot on, Mike. And I mean, I've experienced it firsthand as well. And having a team of people around you that have been on that journey, God knows, many times before, and can really, and to your earlier point, Josh, are sort of in this for the long haul and can support you all the way throughout that journey is just massively, massively important. And Josh, from your perspective,
actually, one more point, Jeff. Actually, just add to that slightly. I think a lot of people kind of think about the journey of the entrepreneur, thinking about my next funding round, and they think about what they can kind of control and what they can see. I think as a final point, I also encourage people to think about, look, how do you anticipate the curveball? When I was advising listed companies, you'd advise them on what's your kind of hostile defense process? What do you do if someone approaches you? So right now, I mentioned kind of the M&A market and the amount of capital in private equity and in the kind of corporate venture capital and the listed entities. There's going to be a lot of demand for fintechs. As an entrepreneur, what is your response going to be if you get a phone call? If SoftBank call you up, what are you going to say? If a private equity fund calls you, how do you position conversation to make sure you're in a position of strength without?
You're breaking up a bit, unfortunately, man, but I like your point about a hostile defense process, which is obviously very, very important to think about as a founder. I mean, Josh, from your perspective, I mean, this is obviously your bread and butter, so I'd love to hear your perspectives on this as well, from an advisory perspective towards founders.
Well, so I think Mike did a good job though of laying out some of the trade-offs. I think one thing, and this is one where it's really, really hard to make generalizations, right? Every company is in a different position. Typically, young tech companies aren't cash flow positive, but if they are, that gives them a lot more optionality with respect to how they address these things. The trade-off is a fairly simple one. Typically, though, it's I give up some dilution, but also accelerate the time to monetization, right, and accelerate that growth. If you look at sort of the experience of Checkout, sort of pre-fundraising and then post-fundraising, right, there was a huge acceleration, and I think you can look at a lot of companies. Stripe's another good example in once again in that specific space where fundraising was really a catalyst to accelerating growth, and it's a and the founder has a pretty simple trade-off, right? Is, do I want 10% of something really big or 100% of something really small? I think that on the I guess on a slightly more technical point, the one that Mike raised around accessing liquidity as a founder, which is important, especially for these businesses that take a long time to build. There are increasing number of products available to do that, but some of it's very simple stuff, and it's just borrowing technology from other parts of the market and using it in a private market context. And I think we're probably going to talk a little bit about SPACs, and that's an area financial technology that has given, the rise of SPACs has given founders more options in terms of that liquidity.
And Josh, and one for you as well, Mike. But how have you seen this space evolve? Obviously, we've seen massive A rounds, lately, and they seem to be getting bigger and bigger. But do you see founders coming to you earlier now, to raise capital because they realize that that they don't just need it, but also the market is good, the conditions are good, and the rounds are getting bigger. So have you seen that space changing?
Yeah, absolutely. When money is free, it sort of changes everything, right? And yeah, there were just this week, I heard from a founder that normally you would have thought this is way too early, and yet this founder is receiving inbounds, that and inbounds from the U.S. no less, so there's definitely a lot of money chasing good companies, and the SPAC, is another example, right? I mean, money's so abundant that we're making boxes and putting money in boxes, right? And with the hope that in 2 years' time we find something to do with that box, right? And so it's and then you also see another phenomenon, not just at the early stage, but at the pre-IPO stage. You see money coming in at very big valuations, and it's almost like it's a momentum trade in the private markets, and it's a momentum trade that really, in a large part, depends on the Fed continuing to provide this liquidity that will enable you to actually, exit the momentum trade, and so yeah, there's a lot of interesting manifestations of how free money and excess liquidity is changing the traditional dynamics of venture and private market investing.
Yeah, I want to dive into that in a bit more detail. I mean, you mentioned SPACs, for example, which is something I've been following very, very closely, and so it's really interesting to see these vehicles. To your point, Josh, raise a ton of capital as well. I mean, Mike, you had some really interesting perspectives on this when we chatted the other day about the broader fintech IPO and M&A markets.
Yeah, I suppose I mentioned the point before around the amount of US SPACs last year, and it's almost an inevitability that Europe will follow. And then when it does follow, where will they be focused? Well, fintech must be prime and center in terms of focus, given the scale of some of the businesses and their ability to allocate capital to things that have growth, and for high valuations and for big financial gains. People always want growth and disruption. So I think the M&A market's going to be booming in this space, and I think when you have investors using leverage, and when leverage costs less than inflation, you're being paid to borrow. The opportunity to take huge levered plays on your equity are there for everyone to see. I mean, everyone talks about the wall of money in private equity. Sometimes they use that as a negative reason to get into private equity investing. But I see companies worth kind of hundreds of millions into the billions that are still private, that would have never been private 20 years ago, because this wouldn't have been the access to capital for those people to run their businesses, whereas now there is, and therefore there's a need to go public. So it's interesting actually how these things ebb and flow, and the process of going public is tricky. It's a distraction for a high growth business. I think the SPAC opportunity helps kind of grease the wheels in terms of efficiency to get public. It gives people liquidity and solves some of the issues that I mentioned before that a lot of founders face, which are conflicts on the cap table in terms of exit priorities, exit valuations, and gives people a bit more optionality. But I think that it's going to be a very interesting 2021. Actually, it'd be good to have another session on this in a year's time and look back and think actually what did happen, and did the Europeans follow the Americans as aggressively as everyone's thinking. I mean, Credit Suisse, where I work, I mean, they had 25% market share in SPACs in the US last year. It's not an area I spend time, but I'm expecting very much to be the receiver of many phone calls from my network saying, just had an inbound from, and I'll be like, how are you going to respond to that then? Good job you had a rehearsal. So lots going on, yeah, be interesting.
Yeah, lots of exciting things going on. I'm conscious of time. I just wanted to check whether there were any questions from the audience, anything that people wanted to ask Josh or Mike.
If nobody else is, I can jump in. Something kind of going back a little bit, and this is to everyone. You know, I'm curious as to, you know, obviously post-pandemic, the city's going to change to some degree, and what that might be like, and whether we think that as its appeal to investment is going to be changed at all by that shift in whatever form it is.
I'll just say quickly. I mean, I think the UK is going to continue to be the focus. I just don't see. I mean, you know, there's a lot of interesting stuff happening in other European cities, but there's not the same sort of concentration. There's just a, you know, there's an efficiency that's gained, or that, you know, that has been gained by the way the ecosystem in London has evolved, and so I expect the UK to continue to be the focus of that capital, whether that's private capital or public capital. But I do think, you know, both COVID and Brexit are going to play out in ways that none of us sitting here today can fully predict.
I mean, to add to that, I think that what we've seen in this last 12 months is an acceleration of probably inevitable trends. And the guys that I know that have got businesses, sometimes multiple businesses that were kind of being set up to be relevant in 5 years' time, have suddenly found themselves very relevant now. I mean, look at the ed tech market. I mean, people's demand for this stuff is huge. And just by way of example, at Credit Suisse, we all try and find investments for our clients, but if we can't find them, we often build them. And one of the funds that we built was an edutainment fund, $1.25 billion in that fund now. But the companies that they are seeing are often pre-IPO, often very, very young. And the demand we see from private clients to invest in these things is massive. I mean, people's willingness to invest in the private markets is huge. I think it used to be 10, 15 years ago, angel investors were kind of people that had a bit of a hobby often, and they kind of wanted to do stuff around the edges for, I used to call it dinner party chat sometimes. And how many entrepreneurs, you know, used to kind of complain about too many angels wasting their time. I think now it's gone beyond people just having a bit of a hobby to throw some money around, and it's become sort of systematic. And you see that with the family office market and their demand to go direct. We do a lot of that stuff where we can explain to founders to say, look, come to the family office market, got deep pockets, large amounts of capital. And you know what? You're not going to annoy or overcomplicate your existing stakeholder structure, because they're not going to require board seats. They're not going to be agitators for operational change. They're not going to have a different exit horizon compared to your existing VCs. They're not going to have conflicting prefs that cause your lawyers a load of headaches. So these things can get quite complicated, but passive capital is like almost the nirvana for many entrepreneurs. And I'm looking at where I sit, we have access to lots of that. So it's quite a fun place to be.
Guys, unfortunately, we've run out of time. It's been a fascinating discussion, and we could have easily continued the conversation for many, many more hours. I mean, hopefully we'll have an opportunity to do so in the pub over a nice cold beer at some point in the near future. God knows when that might be. But Josh, Mike, thank you so much for your time and for sharing your perspectives. It's been, you know, super, super interesting, you know, to hear your thoughts on all the exciting things that are happening in the industry. Thank you so much to everyone who's joined us as well. Just to wrap things up, Josh, Mike, where can people find out more about you? Josh, I'm going to come to you first.
the easiest thing is just to go to Wilson Sonsini's website. We're all there. So that's the place I would direct everyone.
Excellent. Thank you, Josh. Mike, what about yourself?
You won't find me on the Credit Suisse website, unfortunately, but Mike O'Brien on LinkedIn will pop up pretty quickly. My email is mike.o'brien@creditsuisse.com.
Excellent. Thank you so much. For me, you can find me on LinkedIn, Jeff Tijssen, or on Twitter. Again, thank you so much for joining us. Josh, Mike, you've been absolutely phenomenal, and enjoy the rest of your day, everyone. Take care.
Pleasure.
Thank you.
Thank you.
Thanks,
Appreciate it.